today we're glad to be joined by Sunil Singhania, founder of Abakkus Asset Manager, joining in. Sunil, great to have you on as always. And just to say that we're leaving 2025 with some unfinished business. And topmost on that list, perhaps, is the India-US trade deal. I mean, we've spent the last couple of months with Nifty hitting new highs, telling ourselves that maybe it doesn't quite matter. When you see the rupee every morning at 9 a.m., does that view change?
No, I think good morning and thanks for having me. I think you're right. 2025 has been a challenging year, and it comes after a great 2020 to 24 period. And obviously, as you mentioned, this trade deal is something which is obviously, needs to be sorted out earlier than not, because, it's been now almost 11 months since we had the trade issues creeping in ever since President Trump took oath for the second time. And, since July, August, it's always been, a sort of a hope that it will be done in the next week or two. But here we are towards the end of 25 and we still don't have something concrete. And I think, as you rightly said, that is one reason why, we are seeing what we are seeing in terms of the market being slightly apprehensive, is also the currency movement, which is also playing in the minds or on the minds of foreign investors. So, as I said, I think hope is near. Hopefully, we will have something, but till it is not done, it's not done.
Sunil, hi, morning, Alex here. Of course, then in that context, from our perspective in India, and Indian investors will focus on earnings. Ultimately, that's the one thing that you can watch and, to a certain extent, have an idea of the direction, right? So, what is your key takeaway from Q2? Were you positive? And also, do you anticipate that the worries on top-line growth will dissipate somewhat heading into the new year?
I think so. Q2 September 25 was better than what we have seen over the last 3-4 quarters. So, India is a growth market. We expect earnings to trend up to maybe 14-15% year-on-year growth. I think we started September 24 with a very dismal 3% profit growth, largely because obviously, we had elections, and in elections, things do get deferred. But as we speak, I think quarter after quarter, we have seen both the GDP growth numbers as well as, the profit numbers on the corporate front inch up well. September was a good quarter, relative to the past 3-4 quarters. We had almost a double-digit profit growth. And I think as we trend forward, December should be a good quarter again. The whole impact of the impetus with the economy got because of GST cuts will be felt in this quarter. At the same time, Alex, we are in a phase where inflation is significantly lower. And therefore, even for a real GDP growth of 7%, our nominal GDP growth is significantly less than 10%. And in that kind of a scenario, obviously, the top line growth mimics the nominal GDP growth. And to that extent, we will have a lower top line growth. But I would say that if and when the tariff issue gets sorted, which we are hoping should be sooner than later, we are very hopeful that the second half of FY26 and FY27 also should start to see a 15% kind of earnings growth. But, we have to be prepared as an economy which is now much larger at 4 trillion, and as an economy where inflation is going to be more like 3% rather than 6-7%, which used to be trend earlier. And in that kind of a context, I think the nominal GDP growth, which should be like 14%, should be more like 10%. And, we should be prepared with low profit growth and lower returns from equity markets.
Wow. So, Sunil, good morning, Neeraj here. If that is taken into consideration, then a recovery year of 2026, because a lot of people talk about how the anti-AI trade might favor India, because India has not performed against EMs that might favor India. Are we talking about a 10, 11, 12% modest return period in 2026 as well, despite the underperformance, because the reasons that you mentioned in the previous answer?
So, Neeraj, I think 25 has been a challenging year. And while India has not performed, some of the other markets like Korea and China, Taiwan, they've all gone up between 25 to 40%. And as a result of which the huge outperformance which India had even on a 3-4 years perspective has been taken away. So now India is performing in line with the other emerging markets even on a 4-year perspective. However, India should have an earnings growth which is better than the other markets because inherently, we are a faster growing economy. We are growing at 7%. None of these economies are even closer to that. And I think in that respect, I think India's earnings growth as well as consequently the equity market return should be better. We are very hopeful of a good 26 and 27 where returns may be in the broader markets 14-15%. Largely because, as I said, we are looking at earnings growth, which will be more like 14-15%. On the PE front, we are at around 18 times. Now you can dissect that if you remove the low PE sectors and the PE is more. But on playing the devil's advocate, if we remove the high PE sectors, and the PE will be even lower. So I think we don't look at that. We look at the average PE multiple. And to that extent, I think the return expectation should mimic the profit growth. And at least for the next 2 years, we are looking at profit growth for corporates, at least on the broader markets, trending more like 14-15%. And therefore, we are looking at more like 14-15% returns from the broader markets.
Sunil, now I'm being told by my producers that the last time you spoke to us, and I can't remember the date, but then you had spoken about recently listed IPOs and the pricing of a few IPOs, and you said that one of the major deterring factors in the current wave of IPOs is valuations. I was reading an interesting monthly report by one of our domestic mutual funds, and they were saying that practically 2/3 of the new IPOs are at 50+ PE. And I don't know whether that metric is also appropriate because so many of these IPO companies are just about making a profit. But what would you say about the latest spate? And are we continuing to see that problem on valuations? And what are the implications for the secondary market because of the kind of paper and the flurry of paper that's coming through?
So I think a lot of the IPOs which have been coming recently obviously have been expensive. And many of them have also been in newer sectors. We'll be lucky if they even have a PE because a lot of them don't even make profits. But beauty is in the eye of the beholder. I think there are enough investors who are queuing up for these IPOs. From our perspective, we are a little value conscious, but we are also cognizant of the fact that when India grows from $4 trillion to $8 trillion, some of these new age companies might really do well. But having said that, I think we are basically looking at companies which have moat and which don't need capital to burn, more capital to grow. Also, if you see, many times these IPOs open with a bang, but once the lock-in opens after 1 month, 3 months, we have seen many of them, cede a lot of the gains which you see on the listing front. So I don't know, frankly, from being a value conscious investor, I think we will take things as it comes. We are not enthused with very high multiple IPOs unless the growth and the future profitability trends justify it, and we will continue to follow that. But as I said, the beauty is in the eye of the beholder. There are more than enough buyers, and we have seen so many of these new age IPOs at least open with a bang. Let's see whether these valuations sustain.
The thing about returns is, Sunil, that numbers don't lie. so they look beautiful if the returns are good.
Yeah, we have seen, if you just keep a table, you see when the IPOs got listed and after that what has happened. So many IPOs, reached 100% premium to the IPO price. And after that, over the next 1 year, very famous ones have even lost 60-70% from their top. So I think one has to take a view stock specific rather than just get carried away into anything and everything which has to do with new age IPOs.
Age IPOs this morning doing okay. Sunil, but exciting times for you as well. You're entering a very, very crowded space with your own new fund offer. My question is why? Just the mountain of expectation only grows. Now, when you're handling money for a larger set of people, what is the thought behind us? And tell us a bit about this leg of your journey.
So yes, our mutual fund foray is on. Our first mutual fund NFO, Abakkus FlexiCap Fund, opened on December 8th. I think it will close on 22nd of December, and then it will be an open-ended fund. I think you're right. There are a lot of mutual funds. There are 50 almost. But actually, if you see, when I started my mutual fund journey with Reliance Mutual Fund in 2003, there were 35 mutual funds. So over the last 22 years, we have added all of 15 mutual funds. And in the meantime, the number of investors would have grown 30, 40 times. AUM would have grown 30, 40 times. The listed companies would have double, tripled. And all the intermediaries would have double, tripled. And I think I don't agree that we are in a very crowded space. In fact, top 25 mutual funds account for 90-95% of the AUM. So there is enough room for everyone. The second is, we are a forward-looking sort of AMC. I think we started with an AIF, then we entered the PMS space. We have an offshore fund domiciled in Ireland. We entered the late stage, mid stage private equity space last year. And our view is that as long as we believe that we have something to add to the investors, we would continue to basically be a full, I would say, stack asset management companies focused on Indian predominantly equities. And now with the regulator also being more conducive to allowing slightly more, I would say not exotic, but slightly, I would say at a higher level than the plain vanilla products. Our view is with SIFs coming in, with mutual funds also, some of the schemes becoming very, very large. There is a space for some professionally, I would say, professional portfolio manager promoted asset management companies, and that is where we are. I think we are very, very small to begin with. It's
Yeah.
40.
No, but Sunil, looking at your tremendous track record and the heightened expectations, I'm sure you've done a scan of what is available out there and decided what you should not do or what you will do differently in this fairly crowded market. What are some of those things?
So I don't know whether everything you need to do is different. To be fair, I think we are blessed that we have some great portfolio managers and great asset management companies, and hats off to them. Collectively, they have created this cult of investing, along with obviously media like you, who have been encouraging investors for long-term investing. I think from our side, we have our own framework, and we will try to do what we believe is best suited to give consistent risk-adjusted long-term returns. I think we've been doing that for the last 25 years. Hope to continue to do that as long as I am physically and mentally fit. But the good thing is we have a great team now. As we move forward, we will do what we stand for, which is, as I said, fundamental-based investing focused on profitability and trying to basically do stock-specific research to add value to our investors.
Just on the fund, right, on the FlexiCap fund, so that your retail audience understands what you're doing, and your lens is value, is it not? You look for value, and from that perspective, if I look at the last 10 years and I think of when value has outperformed, and understandably, this is purely on the basis of the factor. It's not necessarily a reflection of individual portfolios, right? It's been 7 out of 10 years. And so we've looked at where things stand. You've commented on how earnings trajectory and where valuations, etc., stand. But heading into the next year, do you think that starting this new fund, you'll have ample opportunity to pick? Are there stocks available even in the broader markets? Because ultimately, a FlexiCap fund is an open canvas for you.
So, this whole debate about growth and value is cliched. So obviously we are value focused, but at the same time, we are very clear that unless there is growth in a company, unless there is profit growth in a company, we will not make returns. So in fact, one very key factor which we track is whether the profits of a company can double ideally in 4 years, maximum of 5 years. And that is very, very key part of our needs framework. So, yes, we are a little bit value focused, but if there is growth, we are willing to pay a higher P multiple to it. The other question is, yes, the markets are definitely challenging. There is absolutely no doubt about it. Even after a flattish kind of market, I think a big portion of the market is stressed as far as valuations are concerned. And to that extent, one has to be very careful. So, going forward, I think returns will be a function of two things. Obviously, you have to be alert in terms of picking good stocks. But more importantly, you have to be very, very alert in making minimal mistakes. You don't want detractors in the portfolio. And that is where this whole lure about chasing momentum is a strict no for us. Because many times, you're just buying the stock because the price is moving up, not necessarily because you're comfortable with the valuation. And that is a strict no. Also, return expectations have to be significantly moderate. We are not in a phase where we'll be able to generate 20-25% kind of returns. In fact, if you are going to generate 6-7% pre-tax in debt, which is 4.5% post-tax, and now, the easy play in some of the other precious metals has played out, some of the easy trade in real estate has played out. I think even if equity is able to give you 12-14% returns with a lower tax rate, I think investors will be more than happy with it. And I think that is what we would be guiding them for.
Sunil, when one looks forth at 2026, a lot of reasons to be excited about. Maybe a trade deal-led market momentum coming back, a clutch of other things, including growth because of the GST cuts, so on and so forth, and a few things to be worried about as well, right? The rupee at 91, close to whatever numbers you can think of, plus just the way the world is. What is it that excites you the most for 2026 as an equity investor? What is it that worries you the most in 2026?
So, Neeraj, last 25, 30 years, there have been so many factors which has worried us a lot. Excitement has been there every single day. So excitement continues. But the whole thing is that, you are an India-focused investor. Most of the savings which we have from Indians are going to be invested in India. And I think if you look at the overall scenario, last 25 years, we have had to, withstand bigger challenges. And, I would say this is one of them. In fact, every time you have 3-4 years of great return and then 1 year of a pull down. This time we have ended it flat despite all the challenges. So I would say that there are detractors. Rupee at 91, yes, we would have, our own thing was at 89 was a great level. Normally, rupee depreciates 3.5% in a year. Earlier, our view is that now it should be more like 2%. This time it's been like more than like 5.5%, and which is largely because we have been buying more gold, so imports have shot up. And obviously this trade deal has pushed our exports down to some extent. But, November trade numbers are decent. Hopefully, if the trade deal fructifies, we'll have some stability here. As far as, tailwinds are concerned, yes, the trade deal is a headwind, but a tailwind also. I think the government and the RBI have been pushing for growth. And if the, if the announcements or I think the body language is to be any sort of, indicator, we will have a great budget also, which will be more growth focused. So that can be a good tailwind. And earnings growth, again, if trade deal fructifies, can be really, really good next 2, 3, 4 quarters, because there's also a latent export demand which is pending, and the domestic is obviously doing well. I think if you look at the world is full of uncertainties, and there have been countries which have huge debt issues. I think India that way is very, very good. Our macros are phenomenal. Oil is at 60, which gives a lot of, I would say, leeway to the government to, stimulate the economy, and what they have done with GST, maybe they can do with a few other things. And as I said, if it's an economy which looks like growing at 7% at least for the next 4-5 years. So everything else is in place. I think all you need to do is just taper down your expectations, and I would say yes, be alert but be positive.
Maybe the best time for investors to invest in new fund offers or mutual funds as well, Sunil, because the returns could be heightened in 2026. But yep, your last answer summed up things so well. So thank you so much for that. Thanks for joining us here on India Market Open on NDTV Profit, and wishing you and team Abakkus a very happy 2026 and best wishes for the new fund offer as well.
Wish you and your team at NDTV Profit and all your viewers a happy 26. Thank you.